Have you ever wondered what it takes to be the iron spine of an entire continent's economy? Well, today we're looking at exactly that with Canadian Pacific Kansas City, or CPKC for short. We're going to dive deep into a detailed stock analysis to figure out if this industrial titan is actually a smart investment right now.
And that really gets to the heart of it, doesn't it? There's no doubt that CPKC is a solid, rock-ribbed company with a massive advantage over any competitor. But the big question is, does a great company automatically make for a great investment, especially at its current price? Well, let's find out.
Here's our game plan. First up, we'll get to know the business. Then, we'll tackle the big one, the market price versus its actual intrinsic value. After that, we'll dig into its competitive edge, its moat, look at what the future might hold, figure out the right price to pay, and wrap it all up with the final verdict.
Okay, let's start at the beginning. What's the deal with CPKC? What makes it so special? And just as important, what's the specific investment goal we're measuring everything against in this analysis?
So, CPKC isn't just any railroad. You see, after it merged with Kansas City Southern, it became the only single-line rail network that connects Canada, the US, and Mexico. That's a huge deal. This unique setup gives it a massive structural advantage and makes it an absolutely vital, long-lasting piece of the North American trade puzzle. Now, to judge this company fairly as an investment, we need a goalpost, right? The objective here is pretty specific. Can an investment today grow our money by at least 9% a year on average for the next 16 years? Every single thing we look at from here on out is going to be measured against that target.
All right, now for the main event, the price versus the value. This is where we get into the real tug-of-war, the disconnect between what the stock market wants you to pay for CPKC shares and what this deep dive says they're actually worth.
And here it is, laid out plain and simple. Right now, the market price for a share of CPKC is hovering around 110 Canadian dollars. But this analysis calculates its real, intrinsic value at closer to $78. Whoa, that is a big gap, and we need to understand why it's there.
So how did the analysts land on that $78 figure? Well, it's not just pulled out of thin air. It's a blend of two different, pretty conservative valuation methods. The first one, a discounted cash flow model, basically looks at all the future cash the company is expected to make and puts the value at $75. The second method looks at its earnings and gives us $80. You blend them together and you land on a solid, conservative value of $78.
This brings us to the PE ratio, which is sitting at a pretty demanding 27.6. This number tells you how much investors are willing to pay for every dollar the company earns. A PE this high means the market is paying a serious premium, basically saying, we know this is a safe, stable company, and we're willing to accept lower returns in the future to own it. Okay, so we've figured out that the high price is because everyone thinks this company is just top-notch quality. But what does high quality really mean here? Let's dive in and explore CPKC's competitive advantages, or what investors like to call its moat.
And man, CPKC's moat is deep and wide. I mean, think about it. Its network stretches across 3 countries. You literally can't replicate that. The costs and regulations would be staggering. And for customers, the cost of switching their entire supply chain to another railroad is just way too high. Plus, its massive size gives it huge efficiencies. It's a real fortress of a business.
But, and this is a big but, for all its strengths, its capital efficiency is just okay. Its return on invested capital, or ROIC, is about 5%, which is quite a bit lower than the ideal target of over 10%. Now, this isn't really a sign of bad management, it's just a nature of the beast. The railroad industry is incredibly capital intensive. It takes tons of money just to keep the trains running.
All right, so we've got a good handle on where the company stands today. But what about tomorrow? What are the potential risks and rewards just over the horizon? A good analysis always looks at a few different possibilities, so let's explore what could happen.
This SWOT analysis lays it all out beautifully. You can see the biggest factor, its strength, is that incredible one-of-a-kind network and the cash it generates. The main weakness? That capital intensity we just talked about. But look at the opportunities. Growing trade with Mexico and nearshoring could be huge. And the threats to keep an eye on are always going to be regulation and a potential recession.
So based on that, we can map out 3 potential futures. In a pessimistic or bear case scenario, say volumes drop off, the value could sink to $65. Our base case, the most likely outcome, keeps us right at that $78 valuation. But in a really optimistic bull case, with trade just booming, the value could climb all the way to $95 a share.
So with these different scenarios in our back pocket, we can finally answer the most important question for any investor. What's the right price to pay if we actually want to hit our investment goals?
Now this slide, this is where the rubber meets the road. It shows you the exact price you'd need to pay today to get a certain return over the next 16 years. If you're cool with a 5% return, hey, you could buy in at around $95. But remember our target? For that 9% annual return, the analysis is crystal clear. The buy price you need is $75. And your timeline makes a big difference too. To get that same 9% return, but in only 5 years, you'd need a much better deal, a buy price of $60. The longer you plan to hold on, the more you can afford to pay up front. And that's why our 16-year horizon gives us a little more breathing room at that $75 price point. Okay, we've looked at the business, the valuation, the risks, the rewards, and the all-important buy prices. It's time to bring it all home and deliver the final verdict.
And honestly, this quote from the analyst just nails it. An outstanding business, but an uninspiring investment at current prices. That just perfectly captures the dilemma we've been talking about this whole time.
So what's the big lesson here? It's pretty simple, really. A fantastic company doesn't always make for a fantastic investment. It all comes down to the price you pay. For any long-term investor looking for solid returns, patience is absolutely essential. This analysis makes it clear the stock really only gets interesting at a price below 75 Canadian dollars.
And that leaves us with one final question for you to chew on. The market is obviously willing to pay a hefty premium for the safety and stability that a company like CPKC offers. So the real question for you is, what price are you willing to pay for that safety?